Good morning, everybody. Welcome to the Reserve Bank, our first press conference for the year. And today, with the January official cash rate review, the Reserve Bank has decided to cut the official cash rate by 150 basis points to 3.5%. The news that we've received recently from our trading partners has been very negative. There is pretty much now a recession in place globally, and the outlook for international growth is significantly weaker than we had only a month or two ago in our December monetary policy statement. There is, of course, now considerable international policy stimulus in place, and that is going to help a recovery in time. But there really is significant uncertainty regarding the timing and the strength of any recovery in the global economy. Well, that global weakening inevitably means that there is an impact on the New Zealand economy. And as a consequence of that, we do see a significantly more negative outlook for our terms of trade and for our export prices. In addition, the tighter credit conditions continue. As usual, there's some good news. Inflation pressures are abating very satisfactorily, and we are confident that inflation will be comfortably within our 1 to 3% range over the medium term. Given this, we feel it is now appropriate to take the official cash rate to more stimulatory levels, and we feel we can do that quickly. So today's cut will bring the cumulative cut in the official cash rate to nearly 5% in only 6 months. It's a very marked reduction. And these lower rates, together with the lower exchange rate and with the fiscal stimulus that's in place, all join together to mean there will be a positive impact on New Zealand growth. But the speed with which this happens does depend quite significantly on New Zealand households and New Zealand business not unnecessarily contracting their spending. And we continue to expect and need the financial sector to play its part. It can play its part by passing on the interest rate cuts to customers and by continuing to lend. And by doing that, this will help New Zealand to respond flexibly to this very significant international shock. Any further movements, any further cuts in the official cash rate really are going to depend on how we see the global position and how we see domestic economic developments and any response to policies that are already in place. But we should say that further reductions are likely to be significantly smaller than what we have seen over the last couple of months. Well, thank you, ladies and gentlemen. We're open to questions and to assist. We've got Dr. McDermott, Chief Economist and Assistant Governor, and Tim Hampton, Head of our Forecasting Team. Are there any questions, Brian?
Dr. Bollard,
and sorry, once again, we're webcasting, so we'll ask you to speak into the microphone.
Leaving the door open for further, albeit smaller cuts, could you expand a little on the conditionality around that? And are you broadly comfortable with where the market pricing sees the OCR going over the next year?
Well, as I'm sure you're aware, during these official cash rate reviews, unlike our monetary policy statement, we don't do a full forecast. We do an interim, quicker forecast. So we haven't got a full set of data and a full track for the 90-day interest rate in this. The market thinks it'll go a little lower, but trough out, and they may be correct on that. It really does depend on international circumstances, international conditions. We have always said we expect to be in a position to still keep some ammunition in reserve, and we think that's still the case.
So economists were economists had been expecting the OCR to trough at 3.5% about middle of this year. I mean, what is the expectation of where the trough will be in this cycle then?
Well, I've just got to repeat, Simon, that we note the market has further cuts in it, but they're much lower cuts than what we've seen. We think that's appropriate. Where we trough really will depend on international circumstances.
How much...
Sorry, Bernard.
How much longer do you think our recession could go now we've seen this deterioration overseas?
Well, the picture we had in December was one where the New Zealand economy, which had been in a little bit of a different position because of the drought, you'll recall, that we had early in last year. For that reason, the New Zealand economy was already just slightly in recession. We had felt that had bottomed about December. We now think that we're probably still in recession, and we will likely be there through the first half of this year. We then expect a pickup. The speed and strength of that pickup is going to very much depend on the rest of the world.
Dr. Bollard, are you... sorry.
Yeah, go ahead, Barry.
Are you happy that the banks are playing their part in this, particularly when it comes to business?
Well, the banks are in a difficult position insofar as the international financial markets are very tight and very tough at the moment. And it's very appropriate that they should be conservative in their lending patterns, and they have been. But we are confident that the banks on that side are still lending and are still, in most cases, looking for business, and that's our communication with the banks. We are talking to the banks all the time on that. On the as to whether the cuts that we're putting in place are being passed on, yeah, well, they mainly have, but not entirely. But of course, as you know, bank balance sheets are quite complex. They are getting funding from a range of different sources. Some of it is related to at the short-term side, to our official cash rate. Some of it is related to international conditions. Those international conditions have been leading to expensive credit, not cheap credit. We are seeing this being passed on. We do expect to see it continue to be passed on. Margins have increased by some measures in the banks. On the other hand, the volume of their business is down very significantly. They've got to make that judgment, but they're very aware that it's our expectation that appropriately gauged cuts will be passed on. No, sorry, can I go back to Brian now?
Is there a need for further fiscal stimulus, and do you have any advice to the government about what forms that should take?
We're keeping in close contact with the government, but that's the Minister of Finance's call, and we wouldn't comment on that.
Dr. Bollard, at the short end, the floating rates the bank's offering are sort of in the 7+ % range. You said that those are more closely related to the official cash rate. They're the ones which seem to be the most disengaged to the official cash rate at present in terms of the market. There's now a 4% difference almost between them and the official cash rate. No,
the short-term rates have been pretty closely tied, but not completely tied to the official cash rate.
Are you concerned that...
So you'll need to talk into the microphone.
Are you concerned that the floating rates being offered by the banks are still unreasonably high?
It's up to the banks to decide what rates they set. That's always been our position. Our position is, however, that they should be prepared to pass on these rates. We expect to see them continuing to do that. That's really all I'm going to say on that.
Do you have any view on what an appropriate margin is? I mean, do we expect rates to fall down to around 5% rate?
No, I'm not going to comment further on that. Further questions?
Do you think there is a need for quantitative easing as we see the official cash rate drop towards zero?
Well, quantitative easing is sort of a catch-all term that's been used in different ways in different places, but we already have put in place increased credit availability through our schemes to allow banks to come in with securitised assets and get liquidity